going to like this. Hi, I'm Greg Goernert, Vice President and Senior Investment Advisor of Canaccord Genuity Wealth Management and Goernert Wealth Management. Now, welcome to the channel where we help you make sense of the financial world. Now, I know doing an unboxing video of an RSP is a little bit cheesy and kind of clickbait, but really, we've been doing a lot of unboxing this past year, and I really do think it illustrates a point. You know, I think a great way to think of an RRSP, or in this case, a self-directed registered retirement savings plan, is as a box with some very special properties that you can put retirement investments into. So let's get into a bit of the background. Now, for those of you keeping score at home, RRSPs were first created by the Canadian government in 1957 as a way to encourage Canadians to save for their retirement. So here are the basics. As of 2021, each Canadian can contribute up to 18% to a maximum of $27,830 of their earned income, less any pension adjustment, to an RSP up until age 71. Okay, great. Couple of things. What is earned income? And what's so special about contributing to a self-directed RRSP? Now, this is important. First, earned income is considered generally, but not exclusively, as employment income, self-employment income, less certain business expenses, alimony or rental income. There's more to it in the fine print, but you can find your annual contribution limit as well as any unused previous contributions. Yes, you can still use contribution room that you haven't used in previous years in the current year on your annual CRA notice of assessment. Whew. Still with me? Good. Now, why would you want to make a contribution to an RRSP versus just investing the money in a regular account? In one word, taxes. Yes, taxes. The first way you'll save in taxes is that for every dollar you contribute to your RRSP in a year, you can deduct that amount off your taxable income. So, and I'm going to generalize to illustrate a point. If you're a generic Canadian earning $100,000, you're probably going to pay between $22,000 and $29,000 of income tax, depending on the jurisdiction you live in. Now, I'm using 2020 numbers here, but if you made a $20,000 RSP contribution, your taxable income would be reduced by the amount of that contribution. So, you reduce $20,000 from $100,000, so you get $80,000 of earned income. So then, using that same generic Canadian example, your taxes would be reduced to anywhere from approximately $15,306 to $21,496 versus the original $22,000 and $29,000, depending on where you live in. In fact, in the jurisdiction I live in, British Columbia, your income taxes would be reduced from $22,590 to $16,251 in this example. So that's well over $6,300 of extra money in your pocket just for showing up. Now, I know there's a lot of math here, but what do you expect? It's a financial video. If it's not making sense, scroll back in the video or drop a comment in the comment section. Now, there is a catch to this tax savings. There's always a catch, but you have to stick around to the end of the video, then I'll explain it to you. Now, the tax advantage doesn't just end there, and this one's often overlooked. If you have a regular investment savings account, every time you sell a security for a profit, you'll have to pay capital gains tax on that profit. Every time you earn income, be it dividend income or interest income, you're going to have to pay some form of tax on that income. In an RSP, you don't. All those capital gains and income grow tax-free, which makes a huge difference in your after-tax return. In other words, what you get to keep. Let's take our generic Canadian making $100,000 a year and assume they made an annual capital gain of 8% on an investment in a regular investment account. To keep it simple, we'll assume you invested $10,000 and sold it with an 8% gain in the same year. So you paid $10,000, you made a capital gain of $800, so you sell your investment for $10,800. You live in that mythical world where you don't pay any transaction fees, so job well done. You made 8% or $800. But now you have to pay capital gains tax. Now, depending on the jurisdiction that you live in, you'll pay anywhere from 17.5% to 22.86% in capital gains tax. So once again, to keep things simple, let's just assume a capital gains tax of 20%. So 20% of 8%, I know we're getting neck deep in math here again, but bear with me, is 1.6%. So your after-tax return is going to only be 6.4%. And that tax drag on your investment only compounds over the years, as your compound growth rate would not be growing at 8%, but at 6.4%, lessening what no less than Albert Einstein reputedly said was, and I'm not making this up, the eighth wonder of the world, compound interest. Had you invested the same funds in RSP, you would pay no tax on that gain. Okay, now we've established why using an RSP is such a great investment strategy. What kind of investments can you put in them? Well, in general, and this list is not exclusive, you can invest in securities, so stocks of publicly traded companies, mutual funds, exchange-traded funds or ETFs, GICs, bonds or debentures. Now, as I mentioned, this list isn't exclusive, and there are other investments, options for example, that fall into the dreaded "it depends" category. Now, what can we do with the accumulated savings? Well, as the name implies, the primary reason for investing in an RSP is for retirement. And by New Year's Eve, the year you turn 71, you need to wrap up your RSP. So you can do this in two ways. First, you could simply deregister, i.e. withdraw all the accumulated savings in one go and pay the income tax on the entire withdrawal as income. Now, that is something that I would say would be a suboptimal outcome, and 99 times out of 100 would not be the best way to go, as you're going to have to pay a huge tax liability. The second option is that when you retire, and I know earlier I've said the latest you can still contribute to an RSP is 71, but you can start withdrawing at any point before that. So at retirement, you convert your RSP into a registered retirement income fund. And I've got another video on those, otherwise known as RIFs, because we do like our acronyms in this business. You withdraw the funds on a prescribed annual basis. And here's the catch I mentioned earlier. You'll pay tax on those withdrawals as income the year that you take them out. So up until about 20 years ago, that was about it. You made your contributions, and unless something extremely untoward happened where you had to withdraw the money for some reason, and that's something I never recommend, you saved, you retired, and you rode off into the sunset. Cue the credits. But over the past 20 years, a couple of interesting features have been added to the RRSP legislation. First is the first-time homebuyers plan, where you can withdraw a maximum of $25,000 in a calendar year to buy or build a qualifying home. Now, the entire amount must be repaid to the RRSP within 15 years, starting in the second year after the withdrawal. So it works out to about 1/15 a year, which kind of makes sense. You can also generally combine this amount with your spouse. The next relatively new innovation for RRSPs is the Lifelong Learning Plan, or LLP. The Lifelong Learning Plan allows you to borrow up to $20,000 from your RRSP to pay for full-time training or education from a qualified institution. You can take out the maximum of $10,000 per calendar year, and similar to the home buyer's plan, it must be paid back, but this time over 10 years, and the timing will depend on the length of your enrollment. Now, that's essentially a self-directed RRSP unboxed, but I'd be remiss if I didn't mention spousal RRSPs, which are where you make a contribution to your spouse's spousal RRSP, the benefit being you get the tax deduction, but your spouse gets the spousal contribution. This helps couples potentially income split. The other item I want to briefly touch on are locked-in RRSPs. These are generally the result of an employer's past locked-in contribution, and while they are very similar to a regular self-directed RRSP, they will have some restrictions to withdrawals, hence the locked-in part, that will vary depending on the legislation in their governing jurisdiction. There you have it, an RRSP unboxed. The annual deadline for RRSP contributions is generally 60 days into the following calendar year. That's why you see all the advertising come January and February. The deadline for contributions to count against your 2021 income this year is March 1st, 2022. Yes, even though you may make the contribution in the first 60 days of 2022, it will still qualify as a 2021 contribution, assuming you have the contribution room. See you next time.